Hi, and welcome to the October Buy-to-Let Mortgage Market Update. My name is Richard Purnell from the Mortgage Home, and we are your buy-to-let mortgage experts. The astute amongst you will have noticed last month for the first time, I put a new slide in that actually talks through the agenda, what the topics I'm going to be covering for this particular month, and maybe more importantly for you, some timestamps. So for those who are a little short on time, you can jump straight to topics that have more interest here. So I hope that's of use. So what are the topics I'm covering this month? As always, market review. What's going on with the Bank of England? What's the predictions likely to be? And what's the impact on mortgage rates? I'm going to be covering offsets. And now I did cover this back in June, but if you are really looking to reduce your mortgage interest costs, keep more of that rent in your pocket, then there's been some real developments in the last month or so, which I want to come back and share with you. It really opens up opportunities for more landlords. I want to talk about your compliance, your back office. If you need to systemize your back office procedures, then again, have a look at this topic. I've got a great application I want to share with you that'll really improve and make your administration systems more efficient. And finally, inheritance tax. If you are seriously interested in reducing your tax bill significantly, then take a look at what I want to share with you on the last topic. So let's get on with it. So in this piece, I want to talk about, of course, the interest rates. What's the market doing right now? As you know, we're at 5.25%. We've had 14 consecutive rate rises up to September 23. And finally, there's been a pause. The Bank of England did not continue and ratchet up for the 15th time. They kept it at 5.25. Now, I did say last month that it was on a knife edge. I was really struggling to call whether they would leave it and pause or up it 0.25%. Now, I've had a look at the minutes of the meeting. Yeah, I know. And it was a really close call. It was 5 votes against 4 to leave it where it is. So a really close call. Now, it does feel like the major matrices, the matrix, the data sets as an economy as a whole are going in the right direction. And therefore, my view is that the Bank of England are likely to keep it on pause now. And in fact, dare I say it, I think we might have reached the ceiling. Still a bit early. Look, they've only paused it for 1 month, but as the months continue, I think at the next meeting, which is beginning of November, if they pause it again, I'm be starting to think that perhaps now the Bank of England feel that the ratcheting up of the Bank of England rate has finally done its job, and inflation is heading down towards that 2% target. By the way, if that continues, my view is that the Bank of England will not only not put rates up any more than they are now, but in about 18 months to 2 years, they'll even start to bring the Bank of England rate down. Can't say how much. That's, that is a real crystal ball gazing thing, but that's my view. Now, let's move on to mortgage rates. As it says on the bullet point here, they're reducing. They've been reducing now, I'd say about 10 or 12 weeks. And the reason I did allude to this last month, and I'm sticking with my same view, I don't think there's anything more complicated than the banks, the lenders now feel confident enough that they're open for business again. So they're now chasing your business. So they're starting to cut margins. The competition part of this market is starting to come back in, and they want a bit more of your business. So they want to get up the league tables a little bit more to, as I say, get a bigger slice of the pie. So what I did this morning, and by this morning, we are on the 11th of October at the time of recording this. I took a snapshot of what the headline rates are. So before I show you them, I do not want any of you guys out there thinking this is advice. You know it's not advice. This is purely the headline rates. You know there's a lot of detail behind and under the surface, and indeed whether those mortgages are right for you. So you know I've got to say that. But there's some real interesting observations I want to share with you today. as you can see, we've got two columns. I've got 75% loan to value, and I've also got 60% loan to value lending. And then down the left-hand side, I've split that in two parts. One between buy to let, and by that I mean long-term family lets, you know, the AST rentals. And I've also put holiday lets on there because I know a lot of our watchers are focusing on that strategy. And then I've also split it between 2 and 5 year fixed deals. So let's just look at the buy to lets to start with. First thing that really jumped out at me today was that across all of these 4 headline rates, they all start with a 4. Now, since I really didn't think I'd have to say this name again, but since Liz Truss back in September 2022, remember that name? Sent the world to hell in a handcart, then we've not seen rates across the board. There's been some gimmicky ones, but across the board, starting with a 4. You know, they got up to what, 6 and 7% for the buy to lets. So for me, that's really sort of heartwarming. It's really encouraging to see those headline rates under 5%. The second, and I think this is even more important observation, the 2-year fixed rate pricing is lower than the 5-year fixed rate pricing. And if you guys have been listening to me in the past, I've mentioned it a few times that in my 25 plus years of working in this industry, it's only really in the last year that I've seen a reversal of the norm whereby the 5-year fixed rates are cheaper than the 2-year fixed rates. And that was simply because of the impact of Liz Truss and her Chancellor's budget at that point created so much uncertainty, so many ripples on this pond, that the financial institutions could not with any certainty price their mortgages up. And therefore, in the short term, the 2-year deals got priced more expensive than the 5 years. That's what was going on. But now see what's happening. The 2-year deals are being priced cheaper than the 5 years. In other words, we feel like we've turned a corner. The markets, the institutions, the economists, these guys that are paid a lot of money to try and figure out and predict what's happening in the financial markets and ultimately take that data to put into correctly pricing the rates are now going, yeah, with normal service is resuming, and therefore the 2-year deals are now cheaper. So listen, that's not only good to get that the right way around. What that means is that the lenders out there, they're open for business again. So therefore, yes, they're going to continue to cut their margins. They're going to be widening their portfolio of products to get your business in. More innovation is going to come back into the market. We're going to see perhaps loosening of policy. It's the ripple effect, the knock-on effect to you as landlords who are still active in the market and growing your portfolio. We'll start to see this. And that's why I'm getting excited about seeing 2-year deals cheaper than 5-year deals. That's why it's fantastic news. Now, I've also put on there holiday lets. The point on there is that generally speaking, you can see with the headline rate that rates are about 1% more. Lenders have always put holiday lets in with HMOs, in with serviced accommodation, in with multi-unit freehold blocks, seen as a bit specialist, and then perhaps it's a bit of an excuse to charge a little bit more. So that 1% differential doesn't surprise me, fairly typical, but under 6%. And remember, these are starting rates. They're going up from there. And if you're a landlord that's strategy is multi-generational holiday lets, in other words, the larger holiday lets, these are still a bit more commercially, and you're unlikely to see rates starting with a 5 for these larger holiday lets. If you're looking for a 1, 2, 3, 4 bed holiday let, then perhaps rates starting with a 5. You may well see. Look, if any of that is any interest to you, if you want to then chat about your circumstances a little bit more, at the end of this, there will be a link to our online diary. You might want to take a screenshot, retype the address into your search bar, into the web address, and that'll take you to our online diary free no obligation chat, have a chat with the team, and let's see if we can help you. In this piece, I want to talk about offset mortgages. Look, if you want to save more of the rent, if you want to keep more of that rent money in your pocket, it's not necessarily about trying to push the rents up. It's saving more of that rental and reducing your expenditure. It's highly likely your largest single outgoing is the mortgage interest. And therefore, if we can chip away at that and reduce that interest, then that's more of the rent you're going to be able to keep. And that's why offsets could, for the right landlord, play a growing part in achieving that. Back in June, I did a larger piece on offsets. I've not touched on offsets before, but given where rates are now, I think offsets are really going to be a bigger player in this market. And landlords should be thinking about offsets alongside other product options. If your broker doesn't mention them, bring it into the conversation. Now, like I say, in the June update, I did a bigger piece on it, but a real brief recap. If you've got let's say, 100K mortgage, you've got your mortgage pot. The offset lender will also give you a savings pot. The two are linked so that if you've got any money in your savings pot, because the interest is calculated on a daily basis, any money, a pound in your savings account is deducted off the balance in your mortgage pot, and you pay interest on the net amount. It reduces the mortgage interest for every single day that you have money in the savings account. So if you have got surplus money, I'm not going to call it savings, great if you've got savings that you might then think, well, I can move it across. But what about, like me, I've got a certain amount in my rental bank account that I don't go below because I need it for rainy day. I need it for when I get that call saying, you know, you thought it might be a couple of slates that want repairing. Well, it's a re-roof. It's 5,000 quid, not 200 quid. Or the boiler's fault. You know what I mean? Those bigger ticket items where you're not able to plan them in, so you need the contingency money. So in a current account, you're probably earning little or no interest whatsoever. So that money's not working for you. So this is where offsets can come into play. Move that money across into a linked savings account and then offset the mortgage, reduce your mortgage interest. Are you someone that saves for your tax bill at the end of the year? Put the money to one side. Again, you're not thinking of it as it's not as a savings pot, is it? It's just money that ultimately you're going to have to hand over. Well, why not have that money working for you? Have it working harder for you. Could it be in a linked savings pot? So have a look at offset mortgages. So the reason I brought it back into the conversation only 3 months down the line is that back in June, it was quite restrictive as to which landlords could benefit from it. Now we've got a widening of the choice, which is why I brought it back in. And where's that widening? Well, here it is on the slide. Back in June, we could only get offset mortgages if you had your mortgage in personal name only. If it was in a limited company, I couldn't get you an offset. I can now. I couldn't get you one for multi-units. I couldn't get you one for HMOs. Couldn't get you one for holiday lets. I can now. So it widens the net. Therefore, if it's something that might interest you, speak to the team. There'll be a link at the end of this piece. Have a chat and see if offset mortgages just might save you more money, increase your profit margin, keep more of that rent that you're earning. In this piece, I want to talk about the back office housekeeping. It's a really important part of being a portfolio landlord. So the more efficient you are, if you can systemize your back office administration, then obviously that saves you time to focus on making sure that you are managing your portfolio correctly. And this is a part of that. And what do I mean by managing the back office? So look, we've all got to keep one eye on when the EPC certificates needs renewing. The gas certificate is an annual thing. The electrical certificate is a 5-year thing. You may have electrical appliances in the property that you supply. So do you need pat testing? If you've got a boiler under warranty, then you should have it serviced annually to make sure that you do not invalidate the boiler. There's a whole raft of dates you need to keep an eye on. Now, is this you? Because in the past, I've been going through paperwork, I've come across a gas safety certificate, looked at the date, it was 18 months ago, but guess what? That was the latest safety certificate. In other words, it's out of date, and I'm not keeping my tenants safe and not meeting with the regulations. And therefore, what you're on the phone to your plumber trying to get a favour to get them to come round ASAP to get you back on track. So what I've come across recently is a fantastic company that offers this one-stop shop. It's a single application where you upload your portfolio details, you upload the dates on which all these areas are going to come to an end, and the system keeps an eye on it. When it gets close, it gives you a reminder. If you want them updating, you literally press one button and the company organise the contractors. They liaise between the contractor and the tenant, and they do all the diary management and they do the booking. They then get the certificates and they upload that back to this one-stop shop application. How much does it cost? It's free. So for me, look, if it's someone that's prepared to innovate, put all that together, and when I looked at it, I thought, do you know what? Why have I not seen this before? Because it's not rocket science. It's just bringing together a little bit of tech and putting it all under one roof, systemize it, and therefore it'll really massively improve your back office systems. So I would heartily recommend that you look into it. If you want to know more about it, what I want you to do is just email me. I'll introduce you to the guys that run it. My email is now hopefully showing on the screen, but it is RP Romeo Papa. That's RP at themortgagehome.co.uk. So if that is of interest to you, drop us a quick email saying, Richard, just put me in touch, and I'll do exactly that. In this piece, I want to talk about you guys that are growing a healthy portfolio, so you are likely to be heading towards inheritance tax territory and therefore potentially a significant tax bill. If you don't know if that's you, then the very first thing you should do after this video is make a note to look into it, to investigate whether that is likely to be you. It's not difficult to be growing a portfolio in 2023 and get to a point where you're likely to be paying inheritance tax. So if you understand what might be happening in the future, then you can mitigate that now. And there are various ways of doing that. And here's just one way. I'm not saying it's the only method. There are other ways, but there's a type of life insurance policy out there that is designed, actually, one of its main functions is to provide a lump sum so that the executors, the beneficiaries perhaps, can have a lump sum to pay your tax bill. So it doesn't get rid of your tax bill. It pays out enough from the life insurance policy to pay the bills so that it doesn't come out of the asset itself. And indeed, can you imagine if it did? I've seen in some cases where the beneficiaries actually have to sell part of the portfolio to pay the tax bill. Now, how do I know that the life insurance policy will pay out? Because the name of it is whole of life policy, which is a bit of a clue. So unlike the life insurance policy that you're likely to have right now, the policy that you probably have in your drawer gathering dust today is going to have a finite date. It's going to have an end date. And I'm going to guess that that end date is likely to be around your retirement date, maybe 60, 65, 70 years of age. That life insurance policy will end. And it ends because it's done its purpose. You will have taken that policy out because the risk of you dying during your working life is that you're going to leave either a spouse, you're going to leave a larger mortgage, or perhaps dependent kids with one less income, and you don't want to leave them saddled with not only one less income but mortgage debts. So hence there's a lump sum for your spouse or partner to be able to cope with life without you. But as you get to retirement, that risk tends to have diminished. You should have paid your residential mortgage off. The kids have flown the nest, etc., etc. There's no need for that policy. But this is a different purpose. So a whole of life policy will just keep running. It does not have an end date. Therefore, it will pay out. 100% guaranteed it will pay out because of the nature of the beast. So then if it provides that cash lump sum. Now, if you own the properties in joint name, I'm going to say there's a husband and a wife, then you take one policy out and both your names are on there. And as it says on the third bullet point, it's taken out on a joint life second death basis. In other words, when person number one dies, this usually, and I'm going to give you an example shortly, usually there's no inheritance tax liability at that point because all the exemptions, all the allowances can transfer to your spouse. And it's on your spouse's death, the second death, that the IHT liability is likely to occur. And that's why the policy is set up on a joint life second death basis. The final thing I want to mention about the policy, and I'm going to get into an example so you can I'll bring it to life for you. These are guaranteed premiums. So I don't know of any other good or service that you buy that doesn't go up with inflation, whether it's mortgages, whether it's a tin of beans or something in the middle. Over years, inflation kicks in and you pay more. This is the exception to that. So when you're given a premium by your advisor, the premium you're going to pay today will be the premium you're still paying in 10, 20, 30 years' time. In other words, the perception will be, well, the reality will be, because normally your income's going up, so it will appear that this life insurance premium is getting cheaper and cheaper and cheaper because it's relative to your income coming in, because hopefully you're getting pay awards, or if it's portfolio income, your rent's going up, year on year. This is one element of expenditure that is absolutely static for the long term. So I think it's worth mentioning. Now, let me give you an example so you can see it coming to life. So let's assume that we've got an estate value. Look, it's not property, it's all items as well. But, let's say you've got £1.5 million worth of estate, and that includes the family's home. Now, without turning this into an inheritance tax workshop, the government allow each individual an allowance so they can have up to £325,000 worth of asset, above which you're liable to inheritance tax. I said a little earlier that when the husband dies, that allowance can pass to the wife in my example. So the wife now inherits the husband's allowance. So she now has £650,000 of allowance. If you own a family home, there's another £175,000 of allowance each. And if you do the maths, that means there's £1 million worth of asset that you can have. And only above that figure do you essentially become liable for inheritance tax. So on that simplistic basis, we've got a £1.5 million value. We've got £1 million worth of exemption. So the estate here is liable for inheritance tax on 500,000. Inheritance tax is 40%. So the liability for the beneficiaries in this case is £200,000. And remember, if you've not put anything in place, if you've not even thought about it, there's no planning in place, then somehow the beneficiaries have got to find 200,000 quid, which unless that's in liquid assets, then you've got to sell things. Is it mum and dad's home? Is it part of the portfolio? You're going to have to sell enough to release £200,000 and then pay that tax bill. So the beneficiaries, in your head, when you were planning this, you thought your beneficiaries would have £500,000, and actually they're going to end up with 300,000 because that 200k is going to HMRC. So let's say you take out one of these policies and the client now, the missus is age 50 at this point, at the start of the policy. I took a little look. Average lifespan of a UK female is 83 years of age. So on average, she will die by the time she gets to 83. She will need this policy for 33 years. The premium is £246 a month. Remember, it's guaranteed. So although it sounds perhaps a little bit expensive right now, over time, that 246 will be cheaper and cheaper because it's absolutely fixed in stone for 33 years. And if you think it's expensive, just wait till I get to slide 3. So this policy is guaranteed to pay out £200,000 because we've already figured out that's roughly what we think the tax bill is going to be. So if you then work out, well, how much would this policy cost for 33 years? And the answer is at the bottom of that slide. It's £97,416. So you thought £246 a month was expensive. Therefore, you must think £97,416 expensive. Well, I want to pose an option to you. Which option would you like to take me up on? Do you want to pay a bill of £200,000 because you put nothing in place? Or do you want to pay £97,000 out instead? To me, it's a no-brainer. That means I've essentially halved my tax bill, and my beneficiaries have saved in excess of £100,000. Now, you might say, okay, Richard, you work in averages here. You know, our family's lifespan is longer than the average of 83. They might live a little longer. But do the maths. The break-even point at which you can then say, I should not have taken out this policy because it would have been cheaper to just pay the inheritance tax bill, is, I'm doing the maths here, 9303, 116 years of age. So if you can say with some certainty that you're going to live to 117 or beyond, then ignore this completely. Hats off to you. Enjoy your long and healthy life, and you do not need to worry about a whole of life policy being the strategy to mitigate your inheritance tax bill. But on average, that's unlikely to be the case. So I think this is a serious thing you should consider. I really made this as succinct as I can, obviously, for today, and it will raise a whole lot of questions. So what I want you to do, if you think that you might end up in IHT territory, then give us a call. Book an appointment with our insurance advisor. There'll be a link at the end of this piece. Just type that into your address bar. It'll take you to our online diary. Click on the insurance advisor option, not the mortgage advisor option. Book some time in with the insurance advisor, and we'll go through this type of policy, and then you can make some decisions with a bit more certainty. I hope that's been of some use to you today. Just to finish off with, here is a slide with all our contact points on. There is the link to our diary. If you want to contact the office to have a further chat, or book an appointment that way, then you're more than welcome to ring the office, and our website address at the bottom if you just want to understand a little bit more about our company and how we work. Other than that, thank you so much for keeping to the end of the video update this month. Have a great October, and I'll see you on the next review.